This is Dr. Bernet. This short lecture video will talk about Chapter 10, which covers the cash flow statement and the activity, what they call activity, better known as the income statement. Now, much of this chapter is geared more towards how to create them and some of the nuances of income statements and cash flow statements. So in that regard, it's a little bit more focused on people who will do finance for a living. So I'm going to go over the high points only. Now, as I mentioned, the income statement goes by a number of different names. It might be called activity statement, operating statement, statement of revenues and expenses, or profit and loss. They're all talking about the same thing. Basically, this shows how much money you made and where you spent it, and winds up with your profit, or you might also call it a surplus if you are not-for-profit or a government agency. And cash flow statement is actually just what it says, while your income statement up here normally uses what they call an accrual basis. Accrual just means we recognize expenses when we incur them, regardless of when we pay. Same with revenue. We recognize revenue when we earn it, not when it's collected. So the big difference for revenue would be, for an accrual basis, we would recognize revenue the minute the bill goes out the door. But in a cash basis, we would only recognize it when the actual collection is made. Similarly, on the expense side, we recognize the expense of an employee working, but sometimes we don't pay them until every other week or monthly. So there's that expense that it would show in your income statement if the end of the year fell in the middle of a pay period, but it wouldn't show on your cash flow, which only watches money in and money out. Now, the basic format of any of these income statements is generally the same. There's your revenue or other forms of support, which might be grants and health and public agencies. And then you have your expenses down below, and any change there might be called profit, surplus, or even net change in assets. Now, while most people understand business terms, there's slight differences when you work in academic research places or in government agencies, where a lot of times, in addition to regular revenue, you're dealing with grants or gifts. And I'll say a bit more about that when we dive into the Public Health Finance Module 5. Now, if you're trying to track the slides with what I'm saying, you'll notice I'm skipping over a lot of the slides. The reason is, as I said earlier, I'm focusing on what you'll need from a higher perspective. So some of the important terms are, if you hear the expression product costs or production costs, those are things that are generally directly connected with providing services. Another expression, they call it period costs. It's also better known as overhead or OH. And overhead is just a cost that you have to put up with whether you do any production or not. So let's say, in a simple example, even if your hospital is closed for 2 weeks, you will still have to pay the rent and the electricity and stuff like that. Those are your overhead costs. Although your production costs, your costs of hiring nurses and so forth, of paying salaries for nurses and other people, those might go away. Now, in your cash flow statement, most people think of cash flow as coming from operations. That is, you made something, you sold it at a profit, and that would be your operations thing. So if you make something and you sell it at a profit, that's operating revenue, which hopefully is a big part of everything. You can also get money from investing. That is, if you've got some extra cash and you put it in the bank and earned interest, or put it in other investments and got a little bit of interest on that, that's your investment earnings. Now, for insurance companies, this amount right there can be the main difference between making and losing money, because insurance companies, they play the float is an expression they use. In other words, they get money in, but they don't have to pay it out. The money we get in this month, often we don't have to pay out till 1 or 2 months later, because all the bills that are happening this month, they come in here, and then sometimes it takes us till there to pay it. So we've got a fair amount of money in the bank sitting there. And one thing that most insurance companies do is they'll have people whose job is just to take the money that's sitting in the bank and find safe investments for it. So they could put it in T-bills or other bonds, government bonds, things like that, just to earn a little bit of extra money. And indeed, I've worked for insurance companies where basically we were just breaking even from an operating perspective. If you looked only at the money we got in terms of premiums and the money we were paying out in terms of money to doctors and hospitals, we were just breaking even. And the only small profit or margin we made was from that little bit of interest that we were earning on the money while we had it in our pockets or in the bank account. And yet another way to get cash is what they call financing, which is a fancy way of saying, I went to the bank for a loan. It sounds a little bit weird to think of it as cash flow, but well, it is indeed cash flow in because they gave you money. Now, I could speak more about this chapter, but there's no assignments associated with this chapter, and I wanted to keep this high level. So with that, good luck on the next one.